Good morning, everybody. This is Andrew Wilkinson coming to you from New York State on America's East Coast. And good evening to everybody over in the Asia Pacific region. Today's webinar is co-sponsored by the CME Group, and we're going to look at the soy complex and corn trading. And our guest today is Ong Hao Tuan, a seasoned grains trader and analyst with experience in Singapore, Australia, and the United States. I'm going to hand the microphone over to Ong Hao Tuan very shortly. Before I do, I'd just like to remind you that today's session is being recorded. You'll receive an email in a couple of hours' time with a link to the recording of today's session in your inbox. You can also get a copy of the handout. The PDF handout is in the GoToWebinar panel. Just expand the handouts menu and you'll see the PDF in there. If you have questions for our guest, please enter them throughout the session into the question panel, and I will moderate those and ask Ong Hao Tuan later on to respond where he can to them. So without further ado, Ong Hao Tuan, if you could move to slide 2 to put up the IB disclaimers, that would be just great. And we'll have those up on the screen for a second or two, just to remind our viewers and attendees of some of the risks associated with some of the products and markets that we're going to look at today. That's great, and I'm going to hand the microphone over to you. Please advance the slide to your number 1 slide, or your disclosures, disclaimers, and welcome.
Hi, good evening, everybody. Thank you, Andrew, for the introduction. Before we go into today's webinar, I also have a usual disclaimer. Please take a look at this slide. In general, whatever presentation I'm giving to you is just for your information. It doesn't constitute any recommendation, offer, or solicitation or any sort. So I'm just going to leave this here for another 5 seconds, and then we jump right in. Okay. Now, yeah, soy complex and corn. I guess a lot of you probably are investing into a multitude of financial products, equities, and whatnot. But why soybeans and corn? Well, what are the what makes it interesting to trade this stuff? Well, I guess for someone who's in this industry, these futures contract basically have two functions. One is for hedging purposes and one is for speculation, because contracts in CBOT are tangible contracts where you can actually take delivery or give delivery, and it serves a function for farmers in the origination country to set the prices to determine whether they want to plant corn or beans, and for destination countries who buy the product to also determine how much animal heads they want to commit to growing, for how much chicken or eggs they need to produce, and hogs, and etc. etc. The thing about this market is essentially there's two types of a pattern. One is backwardation in the financial world, but in our world we call it a carry market, and the other one is contango, which is an inverted market, and there's a reason for this. When the market is in backwardation or carry, it essentially means that there is plenty of supply of corn and beans in the market, so destination countries don't need to buy them, so they leave it to the origination countries to carry them, which they need to be stored, financed, and also insured. That's why if you look at the futures contract, the more deferred it is. If there's a supply, ample supply type of market, the prices go more and more expensive towards the back end. Whereas in the contango market, which is what we're seeing in today's prices, it is happening because of two reasons. Or either it is supply shortage or there's just too much demand. And for us ag traders and also farmers, the biggest carrier risk for us is time, because we don't know what will happen in the future. But having corn futures and soybean futures, soybean meal futures, it gives us a sense of what's happening in the market. Right, like right now, the market is telling us that, hey, market is inverted. there's something's going on. So you need to be aware what these prices are telling you, because there's a lot of participants in today's market. You have the funds, you have retail buyers and sellers, as well you have farmers and also the commercial traders like the ADM, Bunge, Cargill, Dreyfus, and these guys. So looking at what the market is pricing and what is the pattern, whether it's backwardation or contango, it basically tells a story. And how time brings risk to farmers and buyers? Well, the problem with farmers is that they can decide how much they want to plant, but there's always an uncertainty as to what the weather will bring. Is it going to be, you know, good weather and they're going to get good yields? And for the buyer side, well, the risk is, of course, there's twofold. One is the prices going to remain low, or is there a chance for the prices to spike? And if that is the case, how do they want to manage their costs? Because the production cost is important, and different dynamics in different destination country economically have an impact as to what level of prices they can afford before they decide to switch to other products for production of animal feed. Now, the basic things that are driving this market is essentially just supply and demand. I mean, for me, being in this trade for so many years, I find that trading corn and beans or wheat, you know, it is a little bit more transparent, because there are patterns to the timing of what happens in March, what happens in April, what happens in August. These are called planting seasonality. And during the planting season, which is we are going to enter the Northern Hemisphere planting season soon, this end of the month, you're going to have the acreage report and the quarterly stock report. This will give you a sense of what the US farmers will want to plant this season, and also whether impact on yields. You know, this kind of information you can actually get on the internet. If you can just go to the NOAA website, you know, look at their drought monitor maps, it could give you a sense of what could happen during this season. And of course, the flip side of it is the South American planting season, which is directly opposite in the Northern Hemisphere because of the weather, the season. And the next thing is, of course, just demand. And demand is in general dependent on population growth and income growth. It is not as transparent, and it takes a bit of a longer period to determine income growth and population growth. And lastly is just animal protein needs and vegetable oil needs. Well, this one you can actually infer from the per capita protein consumption of each country that buys corn and beans, and also the amount of vegetable oil that is imported or exported in these countries. This information, again, you know, if you know where to look at, you can actually find them on the internet and also do some research. But most of the big funds, they have their research department and analyst department to run these numbers through to determine whether, you know, the demand is growing or is the demand diminishing. Just to show a bit of color, this is just a seasonal pattern. As you can see, for soybeans since 1983, the black line is basically the weekly inspection report, which is out every Monday. You can see that the shipments from the US actually start picking up from September and then start tapering off in February. The reason is because the Brazilian crop is out, and Brazil will take over the bulk of the sales of soybeans to China. The biggest buyer of soybeans in the world is China, and this is for corn. And corn harvest in the US starts from September, but the exports only pick up in January, February, March until June, July. Reason is because the South American season is ending and the US is taking over. Now, why trade commodities? Like I said earlier, you know, commodity trade flows are a little bit more transparent. If you can get data sources mainly from USDA, which publishes the USDA report every month on the second week of the month. And you can find some American data from CONAB, which is a Brazilian statistician body, and BAGE, which is Argentine Buenos Aires Grain Exchange, which publish production numbers of their crops. You can also get the online farm agri-based reports. You can subscribe to them. Some are free, but some you need to subscribe. In the past, just a bit of flavor. Most of the big commercial traders dictate prices, because during in the past you don't have internet, so information is not as instantaneous today. So imagine if you're in Malaysia or China and you want to buy US soybeans, you would have to probably give a bid that can last for maybe 2 weeks before you can decide to buy. But today, if you want to buy beans, you can give a bid that can last maybe 10 minutes, 15 minutes, maximum 1 hour, which the seller have to respond. So information flows these days are, a big driver for price movements, as you can see, especially during report days. The volatility in the futures market can be quite big. And lastly, of course, weather reports, which you can get from the NOAA website, and of course, some paid services like Weather Predict or Intellicast. You can get all this information online. Now, seasonality, I just give a bit of color for corn and beans. US supply season is it's only one season, so there's only one trade for ag trader directionally during the US season. Most of the time, right now, most of the traders will decide whether they want to go long or go short. They will look at the acres report, they will look at the planting intention, the carry in from the previous crop and whatnot. And right now, the prices basically are telling us that the stocks are tight. So the function of the market is to encourage farmers to plant more beans or more corn. So that season for the US runs from March to August, and the harvest for both beans and corn will start in August. But the critical period for prices are mainly for corn is late June, July, and for beans, July, August. For Brazil, there's two seasons. You have the summer crop and the winter crop. The summer crop mainly is they plant beans and corn, but the corn for the summer crop is mainly for domestic consumption, whereas the winter crop, which is what they are planting right now, but the planting has been delayed because too much rain in Mato Grosso in central Brazil. That is for export, and that export takes place from July onwards, and which is one of the reasons why the US corn exports during that period is seasonally low, because the US is a residual supplier. They're not the main corn supplier to the world. And for Argentina, there's only one crop. Their season goes from end October, November to March for both beans and corn. This is just a sample of the USDA report, which you can get, that they publish every month. Again, the key things that we look at is, of course, the ending stocks, the production number, the yield. And right now, if you can look at take your attention on the 2021 projected soybean ending stocks, which is at 120. This is effectively a very tight stocks number, which means that the US market needs to ration bean usage and bean exports. And right now, I think the demand for beans in the US is still very, very strong, driven by a good crush margin because of soybean oil as well as soybean meal demand for domestic cattle and also domestic hog production. This is just a sample of some American crop production. USDA is plugging these numbers in February, 47.5 and 109 for Brazil for corn, 48 million for beans, and then 33 million beans for Brazil. But actually, since then, the Buenos Aires Grain Exchange have lowered the Argentine crop production for beans to 43 or 44 million tons, and corn they lowered by 2 million tons because of drought. Whereas for Brazil, the numbers are it's still the same, but again, the impact from the earlier drought and the prolonged rains in the central region is the impact on yield is still to be finalized, so there's still a bit of uncertainty there. This is from CONAB, and this was a February estimate. So they actually have a lower number for the second crop production at 105.48 million tons versus USDA. So in the upcoming USDA report, there's a potential for USDA to lower the Argentine and Brazilian crop production, which they have not done in the past two reports. So again, it could bring a little bit of change to the market trend. This is just again information that you can get from USDA on the corn ending stocks, the global corn ending stocks. One of the reasons why corn price is at 550 today, if you look at the chart, just ignore the blue chart, because Chinese stocks to the world is a little bit irrelevant because China does not export corn. If there's any shortage in the world have to sort itself out, because China is a net importer of corn, and the data that for Chinese stock is just for reference. But as you can see that in 2012, 2013, there was a drop in the US. Corn stocks came down and there was a big rally during those years. But after that, the function of the market is to tell farmers to expand corn acres, and they did expand the corn acres. And it has pushed the world ending stocks to healthy levels, which is why for the past 4 or 5 years, corn prices have been low. But things are starting to take a turn now in 2020, 2021. One of the main reasons is because of China. Chinese demand has grown quite a bit, and part of the reason is because of the trade war, and the other reason is also because they have increased the demand for corn, and could be because of the lower production for their previous year's corn crop. So far, if you see USDA flashes for the past month and the recent couple of days, China have been buying record volume of corn from the US, and for the past 3 days, they have bought 3.8 million tons of corn already. So this year, the demand for both beans and corn from China has been very, very strong. And as a result, the domestic stocks in the US have come down. For China, they can take around 100 million tons of beans. In a normal year, the corn import is under TRQ, so maximum they can take is 7.2 million tons. But this year, they have taken 24 million tons already from the US alone. For North Asia, just to show you, I think the comparison, in the whole year, Japan only buys about 15 million tons of corn, Korea 11 million tons of corn, Taiwan 4.5, Southeast Asia, Malaysia takes 3.5, Indonesia doesn't take anymore because the government banned corn imports, Vietnam 11 million tons, Thailand and Philippines, they do not take any corn because they have domestic production. So there are two types of price rally. One is essentially a supply-driven rally. Supply-driven rally happened in 2012, 2013. This type of rally is happens suddenly because the drought or the adverse weather can impact the crops overnight, and it normally comes with high volatility and is driven by fear, because once adverse weather happens, the damage to the crop, takes time to be ascertained, and the market would be basically in fear that there's going to be a sudden shortage of crops. That's why prices can spike up. Like in 2012, the limit, the daily movement, almost limit for corn until CME had to expand limit. Whereas the second type of rally is a demand-driven rally. This type of rally is a bit of more of a slow burn, and the market basically needs to see evidence to move lockstep up to sales flashes or export confirmation. Essentially, the saying goes that a bull market needs to be fed almost daily. So yeah, I think in the demand-driven rally, that is the case. But the other thing about this type of rally is that it is also a little bit harder to predict the turning point. Turning point meaning when will the bull trend end and when will the bear trend come back? Because if it's demand pull, essentially both. What that is telling the world is that there is basically the world knows that the supply from the US and supply from South America is there, but yet prices are moving up. So prices need to move high enough to start to enable switching or replacement of raw material to turn the price down. But in this case, it's a little bit tougher because it could be due to stocking by certain countries, or it could be due to certain growth number in certain countries. So, you know, it's a little bit harder to predict. Whereas the supply demand rally, it is unlikely that supply shock happen in all the origination country. One of the reasons is because the planting seasons are different. So if one country have a adverse problem, say the United States, the market will basically encourage the South American farmers to plant more, because then once that happens, then you know you have at least an idea when the market can turn. But of course, if South America also faces a problem with the weather, then that rally can continue. It's just a bit of an illustration on the supply rally, where you see the demand is constant, but the supply cut. But this is not a global supply. This is usually either South America or US, which this red part can be replenished once South America or US comes online. Again, just a breakdown of the type of rally that we talked about. Demand rationing happens very fast in the supply situation because, again, it can switch easily to other countries. Whereas the demand rally is this supply is global supply, essentially. North America and South America combined, but yet the demand is here. And that is one of the reasons prices are still going to move up until somehow acres get expanded. Means that corn and beans, like what we are talking about in this coming March report on acres, that they need to expand more land to plant corn and beans so that they can meet that demand. And also in South America, prices need to go higher and higher and higher to encourage the farmers there to either switch from planting wheat to plant more beans or more corn, or plant less cotton or sorghum. So it takes a longer time to solve itself out, in my opinion. This is again a repeat, just for you to have a look. And the last two bit is that I just want to show that you know, the corn ending stocks is coming down along with the beans ending stocks are coming down. Essentially this year, I mean the past season, the past growing season in the US, it's not affected much by adverse weather. I mean they had the derecho, event that caused a bit of damage in the corn and the beans area, but the main thing that is pulling out pulling down the stocks for both corn and beans is again China, mainly the unexpected buying of corn from China this year, and also the resurgence of beans purchase to China, driven partly by the trade war agreement and also by the delay in the Brazilian harvest, because the Brazilian season this year was hampered by heavy rains, and the margins and demand in China has been healthy. One of the reason for that is because they managed to recover their hog herd up to 95% in 1 year, when it is supposed to happen in 5 years. What happened in 2017 is they got hit by African swine flu. So the government encouraged all the big farmers to start replenishing the hogs, and they did it within this last year alone, and that has been encouraging for the demand for soybean meal and corn. So what happens when you have stocks coming down? Basically, you need to ration demand, and to ration demand means prices have to go higher. and market needs to find a level to increase supply. Basically, market needs to work to a price point where the farmers are happy to plant more corn and plant more beans to take away acres from other crops. And when this happens, basically it brings about volatility, and with volatility, it gives the opportunities for trade. I mean, for ag traders, normally we are directional long-term traders, and ag traders trade not only futures but also the cash market. And most of the big ag traders own assets to originate and store crops. So in a market where you have strong demand pool and decent supply like what is happening today, the margins that ag traders can generate is from especially originating the crop is quite decent. And at the same time, of course, they will take a view on the direction of the market, whether to go long or to go short. This is what's going to happen on the end of the month. They will publish a outlook from a farmers survey on what they're going to do. This was an outlook from February. From the outlook forum, basically they're telling the world that they're going to plant 92 million acres of corn, 90 million acres of beans, 45 million acres of wheat. But to expand a little bit on this, even if they plant 90, going forward, they would need record yields to effectively replenish the stock for both corn and soy, which would mean that there's still quite a lot of weather volatility out there to look out for. Because if they have an average season, I think from what the USDA had projected and from what most analysts had projected, I think the ending stocks for both corn and beans are still not moving much higher to a comfortable level. This was a sample of what the market is looking at during the USDA report. This was the 9th March report. USDA didn't change both corn and beans and the wheat, which was one reason why these for the past month of March, corn futures and bean futures have been trading in a range. So where will market go from here? Just my opinion. Of course, don't. It's not a recommendation. Just what I think. I think we are essentially in a demand-driven rally. Basically, it is clear that there is increased demand from China for both beans and corn, with the reasons I've already stated, part of the trade deal. And during the COVID season, especially when COVID began, there was a fear in a lot of countries of supply chain disruption, because I think back in March, there are some countries that prohibit vessels that have been in Asia or that have been in countries that were reported to have the outbreak of COVID from entering the port. And this has caused, some level of anxiety, which in turn, I think, has also made a lot of governments to be a little bit more mindful of raw materials stocks. And now that we are in the vaccination period, there's also a lot of hope. Like I said, a demand-driven rally is mainly driven by hope. There's hope for COVID recovery, and right now also there's a lot of supply concern in terms of bean and corn because of the lowering stocks, and palm oil. Palm oil is also from Malaysia is getting tight, with ending stocks at about 1.2 million tons, and this is a big market, and any movement in palm will have a big impact for bean oil and other soft oils like sunflower and canola oil and rapeseed and corn oil, etc. And lastly, of course, just Chinese demand for raw materials. This is just to highlight, to show where China is. We can see China is buying a lot more corn and beans now. They've already passed 100 million tons for 2020. This is again another report that you can find every Monday, where they show the inspections. Right now, corn is very can say it's bullish because the shipments have actually picked up quite a lot, because I think the sales to China is mainly for old crop, and it is within this window from now, I think, until July that they'll take the shipments. And for soybeans, it's also pretty decent because technically, I mean, in theory, for March, the exports out of US should be very low. Like last year is only 53,000 tons. But right now we're still seeing 500,000 tons of beans being shipped. I mean, one of the reasons was the delay in the Brazilian harvest. A few trades that you can probably do, I think, for me, I personally prefer just taking outright long or short on the futures. I think for current prices right now, I think one of the big hurdles is we need to see what the stocks number is, the quarterly stocks number in the report that's coming, because it can be a surprise if they find a little bit more corn lying around in the US or a little bit more beans lying around. But essentially, if you look at the supply side of the equation, soybean stocks remain tight, and the demand is still pretty decent for US beans, both domestic and also exports. And South America planting, basically, we have right now the safrinha corn being planted, and again, we need to see the weather going forward because they have missed the optimal planting period, so there could be a chance for drought. And lastly, I think a lot of people are also looking at spread trading, especially the calendar spread. Right now, I think a lot of bull spreads are being put on with the anticipation of bigger acres for new crop corn and beans and the tight old crop corn and beans. This is just to see where prices have moved since June last year until today. Just to show how the prices have been gradually grinding higher and higher. You have higher highs and higher lows, and at the moment we are still a bit of range bound here, but whether we're going to turn the corner, well, I think one of the biggest thing that could turn the trend could be the surprise in the coming stock report, and this for new crop, both corn and beans. Basically, the market for new crop is also encouraging farmers in the US to add more acres to plant more corn and beans. And this is lastly the bean oil futures. I think bean oil futures for the past couple of days got a bit of a life again because there are reports that bean oil stocks in China is coming down. The demand for oil in China has been recovering quite strongly. One of the reasons is, of course, the high price palm is also encouraging the switch to more bean oil in China. These are the fund positions just for your reference. As you can see, the funds, are still in a bullish position for corn and beans. Yeah, that's it for the presentation. Thank you.
So that's a fascinating insight, Tuan. I'm going to make you an organizer so that you can see there's a couple of good questions coming for you.
Okay.
You should be able to see the question panel now on your GoToWebinar panel. Can you see the questions? I'll read them out so that the entire audience can hear. Jacob asked the question, what explains the significant drop in crude palm oil futures we've witnessed over the past week?
There was, one of the drivers for that is there is expectation of a better production of palm coming out, but at the same time also I think technically there has been a little bit of unwinding of oil share spreads, because I think the both bean oil and also the palm futures have been in overbought positions for quite a while. So I think it is a healthy correction, but I think today things, last 2 days things are changing again. I think today palm futures are trading up again. In China, the bean oil futures also are trading up, as well as in Chicago. is that the thing with palm is this, palm trade is a big volume trade. Both Indonesia and Malaysia exports around 4.5 million tons of palm. If you have a drop of in production in palm, there is very hard to replace that kind of size. Just to give you a flavor, if you export bean oil from, say, Argentina and Brazil combined, max crush capacity, you probably only get 600,000 tons. So if you have, say, 1 million tons palm shortage, you're going to drive up all the other vegetable oil prices like sunflower and canola. And right now, both canola production in Canada, sunflower production in Ukraine, these guys are also seeing that lesser production and more demand. That's why the oil in general is pretty bullish. But to answer the question, I guess it's just that it was a supply problem for palm, Malaysia palm, whereas in Indonesia it is more of a tax problem because of the export tax. So when there was a bit of news that the production could recover, I think that's when some of the longs are just trimming some of the position.
There's a follow-up question there from Jacob. He's asking about Bursa. I must admit I'm unfamiliar with Bursa, but he's asking, are there any agricultural futures or options contracts which can be traded on Bursa? These markets seem unavailable on TWS. I'd need to look into that, Jacob, because I'm unfamiliar. I don't know. Maybe you can educate me here how to. Is Bursa a product or is it a market?
Bursa is, I think, the palm futures. I'm honestly, I'm not familiar with Bursa. I only know that you can trade crude palm oil futures on Bursa.
Okay. Do you want to talk a little bit to Thobani's question? He's asking about what sites you use for research.
Okay, there are a couple of sites you can go check. Like, for example, you can go to the ProFarmer site. ProFarmer is a pretty decent site, and of course you can check out Reuters. You can follow some of the people on Reuters. And right now, if you have Twitter, you can go and check the hashtag Plant21. That's when all the US farmers will will tweet about their planting progress, and you can get a bit of an insight in terms of their planting progress. And there are a few, I don't know if I can say it during the webinar, because there are a few websites that you can Google that you need to subscribe. I think you have to pay an annual subscription that is pretty decent. But if you talk about the free websites, I would think agriculture.com, ProFarmer, just to name a few. From there, I think you can get yourself a little bit more familiar into the other sites that are available.
Yeah, lovely. Thank you very much for that, Ong Hai Tuan. That's going to bring us to the end of today's webinar. Thank you very much for joining us today. It's mid-evening over in Singapore. Thank you very much, Ong Hai Tuan, for taking time out of your evening to present. I know you're a busy trader during the day. Just to remind everybody that about 2 hours after the end of this session, we will be sending automatically a link to your inbox with a recording of today's presentation. The presentation is also available in PDF format from the GoToWebinar panel. If you have any additional questions, please send them to me at webinars@interactivebrokers.com. Thank you very much, Ong Hai Tuan, for joining me this evening. I'll let you say goodnight to the audience.
Thank you. Thank you, everyone, for taking time out to join the webinar organized by CME and Interactive Brokers. Thank you for your time.
Thanks, everyone. Good night.